Okay, so learning objective 2 and learning objective 3 talk about and explain a business to business transaction. We often call that B2B, right? Business to business. Um, to understand a business to business transaction, it's just one business, in this case, a merchandiser buying inventory from another business, in many cases, a manufacturer. Okay, so just so you understand that. In order to understand that, it's very important to be able to read an invoice. Okay, the invoice is the source document for this transaction. The invoice tells us who is the seller and who is the buyer. So usually if your name is in very big print at the top of the invoice, it's yours. So PW Audio, in this case, is the seller. They sold it to this company here, Sock Stereo. Sock Stereo is the buyer. Okay. Learning objective 2 focuses on how the buyer sees this transaction. Learning objective 3 focuses on how the seller sees the transaction. So just so you know where we're going. But everything is still based on the same invoice. So being able to read this invoice is very important. So what did PW Audio sell to Sock Stereo? Or you can also say, what did Sock Stereo buy from PW Audio? Well, they bought this inventory. They bought a printed circuit board listed here, and they bought 5 circuits listed here. So Sock Stereo bought $3,800 worth of inventory from PW Audio. Or you can also say PW Audio sold $3,800 worth of inventory to Sock Stereo, because that's basically, you read it both ways. Very important aspects of this. Certainly that amount is going to matter a lot. Another thing that's going to matter is the date. When was the date of this transaction, right? The date was, in this case, 5/4/17. So that's important because, in accounting, we keep records by date, right? When we go into the journal to do a journal entry, the first thing we're asked to do is put the date in. So that is very, very important as well. Couple of things too. When Sock Stereo buys this, they're going to be, again, PW Audio is all the way in Michigan. Sock Stereo is in Illinois. The fact that they actually had an invoice means that this inventory here, this circuit and circuit boards, are going to be sent in a box in the mail or through a carrier like UPS or FedEx or DHL from Michigan to Illinois. Okay, so when Sock Stereo gets this box, they're going to open up the box. They're going to find the circuit board and circuits, and they're going to find this invoice showing that they have this bill to pay. Okay, so one of the important things to note is all invoices will have terms, which means these are the terms of payment. Okay, Sock Stereo owes $3,800 to PW Audio for purchasing this. So the terms of payment this is called, we'll reread it rather, 210 net 30. 210 means that if they pay within 10 days of the invoice date, they can take 2% off. So it's 2% discount in 10 days, 210. If not, the net amount, the whole amount, is due in 30 days. So those are the terms of payment on this invoice. The other thing that's important is, when does Sock Stereo actually own the circuit and circuit board? Remember, PW Audio owns it. They're selling it to Sock Stereo. So when does the buyer own it, right? When does the seller give up ownership to the buyer? Well, that's what this FOB box tells us. FOB shipping point means that the seller has transferred ownership to the buyer at the shipping point. Now, a shipping point is when, in this case, PW Audio puts the circuit and circuit boards in a box with the invoice and gives it to the shipping company. That is a shipping point. So as soon as UPS picks up the box, done, shipping point. That means at that shipping point, Salk Stereo owns that now that it's now that it's on the carrier. Okay, that is basically what shipping point means. So at this point, that's the point at which the ownership of this inventory transfers. Okay, all very important things. So knowing how to read this invoice and what these mean is very important. So let's start. Again, we're looking at it from the perspective of the buyer, Salk Stereo. Learning objective 2 is all about the buyer. So the buyer here is Salk Stereo. They have a circuit and circuit board, $3,100. What is going to be the journal entry Salk Stereo is going to put into their books on, again, the 4th of May in this case. So they will debit their inventory account because this is inventory to them. This is their asset, debit inventory. They're going to credit accounts payable because this invoice is a bill that they have to pay and in 30 days. And so that's an accounts payable definition, right? It's a bill due in 30 days. So the credit goes to accounts payable. The important thing to know is that Salk Stereo is, this is inventory to Salk Stereo. This is their asset. So here is a visual explanation of the freight costs that are involved. The most common is what we went over earlier, FOB shipping point. That means the ownership of that inventory passes to the buyer at the shipping point. And so again, if you want to imagine here, this is PW Audio boxing up the circuit and circuit boards. And as soon as they give it to the carrier, whether it's UPS or DHL or FedEx, that's when the ownership goes to the buyer, even though in this case, our buyer is all the way in Illinois and the shipping point is in Michigan. So the buyer really has ownership of all of this during the transition, during the transit until it reaches them and therefore. So that means the buyer is going to pay for all of the freight costs because the buyer owns the inventory at the shipping point. It's their stuff. So it's up to them to care for it. The other option that is available is something called FOB destination. It's a less common option, but in this case, the ownership of the goods doesn't transfer until it actually reaches the destination where the buyer is located. So in the case of our example here, we have PW Audio would box up the circuit and circuit boards, would put it on a carrier, right? That carrier would be traveling all the way from Michigan all the way to Illinois to deliver the box to the address of the buyer. At that point where the box gets to the buyer, that's when the buyer owns it. In the meantime, the seller still owns all this inventory during boxing and shipping. So the seller is going to pay for the freight because the seller still owns it. Okay. So that's the difference between the two. The most common you'll see is shipping point. So let's look at an illustration where Salk Stereo, they're the buyer, they end up paying $150 for the freight charges. Okay. Well, how does Salk Stereo deal with that? Well, it's a little bit different. According to GAAP and the historical cost principle particularly for assets, right, we literally have to record the actual cost of the asset. So for example, if you bought an item for $10 on television, but you paid $2 for shipping, and a friend of yours asked, hey, I like that. How much did that cost? You'd probably tell that friend 10 bucks. If you were an accountant, you would say 12 bucks. because the real cost of that was $12. $10 to buy it, $2 to ship it, total cost $12. So that's how we look at inventory. The fact that Sock Stereo had to pay $150 for freight means, in accounting, their inventory cost $150 more. So they will debit $150 more to inventory, okay, showing that their asset cost more, okay. And of course, they'll credit cash because they'll probably pay for it for cash, right? So that's how the buyer would see this, okay. It's a little different for the seller. If PW Audio paid for freight, then it simply would be an expense for them. And in that case, this is a new expense account called Freight Out. Freight Out is simply an expense account, and that shows the payment of freight, delivery of goods, shipping costs. And only that would be an expense only to the seller in this case, not the buyer. Okay, so they just wanted you to know the difference there. You've all gotten boxes in the mail, I'm sure, from Amazon or other things, where you've opened it up and it's not exactly what you wanted, right? You might be disappointed in some way, shape, or form. Maybe the goods are damaged or don't meet your expectations or inferior quality or even defective. This happens in business-to-business transactions as well. The most common thing that they do is they simply put it back in the box and ship it back. So that's a return of inventory. On occasion, the business that bought it says, well, it is a little bit more inferior quality than we carry, but I think I can still sell it at this price. I'll keep it if you give me an allowance. In other words, if you lower the purchase price, I'll keep it. If not, I'm putting it right back in the box and shipping it back to you. It's going to be a return. So in the case where the merchant feels they can still probably sell it, but not at the price they was hoping for because of the quality, they might negotiate an allowance to keep it. If not, it gets returned. The most common thing is a return. So what happens to Sock Stereo, again, they're the buyer, when they return, say, $300 worth of merchandise? Well, simply they're sending $300 of inventory back. So they're going to reverse the entry that they bought when they bought it. When they bought it, they debited inventory and credited accounts payable. When they send it back, they're debiting accounts payable to lower how much they owe. They're crediting inventory to lower the amount of inventory they have. That's basically all the buyers.
How would you?
Yes?
How would you enter in on the shipping expense now that you're returning it? Or do we not have to worry about that?
You don't have to worry about it here. It's a very good question, though, Gregory. I would be leaning toward expensing it as a freight out because I already own it and I'm returning it. So that would fit that model a little bit better. So just for you to know. All right. So everything in this system for the buyer revolves around inventory. Just so you to know, it's very, very important to understand that inventory is going to be everything. So remember, there's credit terms that we talked about here. And so we have 210 net 30 as credit terms. Those are pretty typical. Again, 2% discount if you pay within 10 days. If not, the whole thing is due in 30 days. Well, this is great because if I can get 2% discount, that means my inventory costs less. I'm going to save money. Okay. For the seller, giving a discount means I'm collecting my cash early. And that's a big plus. I need cash. So there are a bunch of discount terms. 210 net 30 is the most common. So here's an illustration of a discount. So Sock Stereo now only owes $3,500 to PW Audio. Why? Because they bought $3,800 worth of inventory and they returned $300. So that's $3,500 difference. They paid for this on the 14th of May, which is that 10-day period, within that 10 days. So what's the journal entry Sock Stereo is going to make in this case? Well, Sock Stereo is going to show that their entire payable has been paid. However, the discount, which saves them $70, is going to be credited to inventory to show that their inventory costs less. So for the buyer, when they pay for shipping, that means their inventory costs more. When they take a discount, that means their inventory costs less. So like I was saying earlier, everything's going to revolve around the inventory account here for all of that. So again, it cost them less money to buy it, which is great. You know, they took that discount. What if they didn't take the discount? Well, it's simply when it's due, they would debit accounts payable to show that debt's been paid, credit cash to show they shipped out a check to pay it. And that's basically that for learning objective 2. The do it exercise is very good because it repeats in learning objective 3 as well. So let's review. On the 5th of September, De La Hoya Company buys merchandise on account from Juno Diaz. So De La Hoya here is the buyer, Juno Diaz Company is the seller. The purchase price is $1,500. So De La Hoya buys merchandise for $1,500 on the 5th of September. 3 days later, on the 8th of September, they returned goods for $200. So what would the transactions be for De La Hoya? Remember, De La Hoya is the buyer here. So what would their books look like from this? Well, the first thing they're going to do is record that they bought inventory. And so they debit the inventory account $1,500, credit accounts payable $1,500. Then on the 8th of September, they're going to record the fact they sent $200 of merchandise back, which simply is reversing the order there. They're going to debit accounts payable because they lower the amount of payables, and they're going to credit inventory, lowering their inventory. And that's basically what the buyer would do. Take a quick break for questions. So learning objective 3 looks at the exact same invoice, but from the seller's perspective, right? PW Audio sold this to Sock Stereo, right? So the $3,800 is the selling price. That's the price Sock Stereo paid to PW Audio. So when you and I go into a store and we pay them, that's the selling price. PW Audio, however, has an interesting situation because they sold off their inventory. They no longer have that inventory. So this is where the cost of goods sold is going to show up for the seller, okay? And so two things have to happen to the seller when a sale happens, okay? The first thing they need to do is record the sale. So they will debit, in this case, because they're using an invoice, they're going to debit accounts receivable and credit sales revenue for the selling price, the price that the buyer paid. The second thing they have to do is record the cost of goods sold because they sold their inventory, and credit inventory because they sold their inventory for the cost that they paid for it. There's going to be a difference because they're going to pay a certain cost for that inventory. They're going to be selling it for a much higher price, right? As high a price they can get. So that's important to know. That's important to know. So your sales revenue account is going to be affected on the first part. Cost of goods sold is going to be affected on the second part. Okay, that's your income statement accounts right there. Okay. Again, you're selling inventory. It becomes cost of goods sold when you sell it. So to record a sale, this is what PW Audio would do. Okay, they had to record they sold $3,100 worth of stuff on May the 4th. they have to know what their cost is. So they will be giving you these cost figures here in this chapter. So this is $2,400 worth of inventory that they sold to Sock Stereo for $3,800. Okay. So the first thing they do is record the sale. The second thing they do is record the cost. So let's record the sale. Again, this was on account, so they're going to get an invoice, debit accounts receivable, credit sales revenue. That's part one. Part two, record the cost, take it out of inventory. Debit cost of goods sold for $2,400, credit inventory for $2,400. That's how the seller would be recording these sales. Well, when something gets returned, the seller looks at it very seriously. They actually have their own account for it. Sales returns and allowances is actually a real revenue account. However, it's a contra revenue account. Remember, a contra account has an opposite balance to a normal account. So revenue accounts are normally credited. Sales returns and allowances will be debited, okay, showing the return of the sale. Okay, it's important for businesses to keep this separate. Remember, the whole purpose of existence is to sell inventory. They don't want to get it back. The fact that they're getting some returns is important for them to track. Secondly, they want to know and track what's being returned because, I mean, if they're selling a particular item or set of items to customers and that's always being returned, why do they want to sell it? They probably don't want to keep it in their inventory. They probably want to get rid of that. So it's important for them to distinguish, between what's getting returned and the reasons why. Okay, and so that's important. The sales revenue is not reduced because you still sold it. You are keeping track of how much of that has been returned in sales returns. Okay. So in this case, PW Audio got that box with $300 worth of returned goods, right? I think it was a circuit that was returned. It was a $140 cost to PW Audio. It's important to know that if you get a return and the item is not defective, you can sell it to somebody else. You can sell it to another buyer. It's not illegal to do that. So that's important to know here. So in this case, the good is not defective, and so they can sell it to somebody else, which means they're going to put the good back into their inventory. First thing they do is they're going to debit the sales returns and allowances account for the selling price of the item that was returned. They're also going to credit the accounts receivable because they're not going to be receiving payment on that. Okay, so that fixes the sale. Now they got to put this back in the inventory. So they're also going to debit their inventory account for the cost of the item. And they will need to reverse out the cost of goods sold. So the cost of goods sold, even though it's an expense account, it will have a relatively active credit side because these returns happen all the time. So you're going to have to reverse out the cost. Right? So that's important to know is that we're not used to seeing an expense account with a very active credit side. Matter of fact, all expenses have debit balances, and the only time we've ever gone to the credit side is to close it. Cost of goods sold is different in that sense because it's a more active account for an expense account. So you'll see that happening a lot. In the event that the goods were defective, they cannot sell that to another customer. So what companies do is they create a scrap value. I don't like the scrap value. I would have preferred they do a very strange number that sticks out, like 9 or something, 19. Because that's the way they can identify returns that are defective. Now, the good news is the defection rate on a lot of items is very small, a fraction of 1% in most cases. That's different than when I was in your shoes back in the late 70s and 80s. About 5% of goods were defective. We were working on it, but there was a better chance you'd go back to the store with a defective good than today. Today, of course, it depends on the complexity of the product. Most basic products won't have any defects because of computer-aided manufacturing and robotics. So machines tend not to make mistakes if we program them well. So, so the defection rate is quite low. However, if products are more complex, electric vehicles or other types of things that are extremely complex, lots of parts, the risk of defection goes up. Let's put it that way. Okay, so if you got the good back that was defective, you would still debit your sales returns and allowances account and credit your receivable. However, you would note in the inventory the scrap value. Again, I wouldn't use a round number like 50. I'd use something odd that sticks out like a sore thumb, like 9 or something, or even 99 cents if I could. That way you can show that it was a defective item that was placed. So defective items will be returned to the manufacturer for replacement oftentimes. That's usually how it works. Okay. Another thing that happens is, remember, we were offering the buyer a discount if they paid early. If you pay within 10 days, take a discount. Well, what if they do? Well, we have to note that in our accounting record. So here's another revenue account that you're learning. Ooh, lots of new accounts. Sales discount is a real revenue account, but it has a debit balance. So it's a contra revenue account. So very much like sales returns and allowances, we keep track of discounts on the debit side of the account. Okay, and that's important to know because what you'll see on the income statements of merchandisers is not this whole thing. You won't see sales revenue minus, sales returns and allowances minus sales discount. You will see basically net sales will be the first line on the income statement for many retailers. So to understand what they mean by net sales, they have gone through this process. They started with how much they actually sold to customers. That's their sales revenue. They've subtracted out how much of that has been returned or granted allowance. They will also subtract out any discounts the customers have taken to get something called net sales. This is something you need to know because you're going to see the word net sales over and over and over again. And it's important to know how they got that. Again, sales revenue minus returns and allowances minus discounts gives you your net sales. So that's another thing you really kind of need to know. So remember, Sock Stereo paid us early. They had a $3,500 balance, but they paid us in the 10-day period. So we get that check at PW Audio. How do we record all of that? Well, certainly the payment of the receivable is recorded, but they've taken the discount. So we are going to debit cash for the $3,430, which is $70 less because that's the 2% discount. The $70 is going to be debited to the sales discounts account, okay, and shown this way. So the entire receivable has been paid in full. $3,430 worth of cash, $70 granted in a sales discount. And so we wrap up objective 3 from the standpoint of the seller. Okay. Same problem as in learning objective 2, De La Hoya and Junot Diaz, except we're looking at things from the seller's perspective, right? We're doing the accounting for the seller. Junot Diaz is the seller. So on the 5th of September, De La Hoya bought merchandise on account from Junot Diaz. The selling price of the goods is $1,500, but the cost to Junot Diaz is $800. So let's book that. So again, for a seller, 2 steps, right? We're going to record the sale, and then we're going to record the cost and take it out of inventory. So recording the sale means a debit to accounts receivable because they bought it on account, so we gave them an invoice. Credit sales revenue. Second thing, debit cost of goods sold for the cost of $800. take that out of inventory. Okay. The second thing that happened was on September the 8th, you remember that, the buyer returned $200 worth of goods to us. The cost of those goods was $105. We're assuming that it's not defective, so we can resell it. So to record that return, we have to debit sales returns and allowances for the $200 and take that out of our receivable because we're not going to be receiving payment for that. And then we can put that back into our inventory. So we debit our inventory and credit our cost of goods sold. And that's how the seller would look at this. So that was the whole thing. You've seen one invoice, but the buyer looks at that in one way. The seller looks at that same invoice in a little bit of a different way. So that's the purpose of today's lesson, business to business transactions. Do we have any questions?